Most people think investing is complicated. Charts, stock tickers, market crashes, confusing financial terms. And if you're just starting out, it can feel overwhelming. But here's the truth. If I had to start my investing journey completely from scratch today with no experience and limited money, I would follow a very simple system. A system designed not for traders who watch screens all day, not for gamblers chasing quick profits, but for ordinary people who want to build long-term wealth. Today, I'm going to walk you through exactly what I would do step by step. No hype, no gambling, just a smart beginner investing strategy that actually works over time. We're going to cover 16 essential steps from building your foundation to avoiding deadly mistakes, from understanding compound interest to automating your wealth. By the end of this video, you'll have a complete blueprint. So let's dive in. Step 1. Fix your financial foundation. Before investing even a single dollar, I would make sure my financial foundation is stable, because investing without stability is like building a house on sand. You might see short-term gains, but one emergency can wipe everything out. The first thing I would do is eliminate high-interest debt. Credit cards with 15 to 25% interest will destroy your financial progress faster than any investment can grow it. Think about it. If you're paying 20% interest on debt while earning 8% on investments, you're losing 12% every year. Pay down high-interest debt first, always. Next, I would build an emergency fund. Your emergency fund should cover about 3 to 6 months of living expenses. This isn't money for vacations or new gadgets. This is your financial safety net. It protects you from needing to sell investments when the market drops, and that protection is absolutely critical for long-term success. Once you've cleared high-interest debt and built your emergency fund, you're ready to invest. This foundation ensures you won't panic and sell during market downturns. Step 2. Understand why investing matters. Many people think saving money is enough. They put money in a savings account earning 0.5% to 1% interest and feel safe. But here's the problem. Inflation slowly reduces the value of cash. If inflation averages around 3% per year, your money loses about half its purchasing power in just 24 years. Let me give you a real example. If you save $300 per month in a savings account, earning 1% interest for 30 years, you'll have about $126,000. But if you invest that same $300 per month with an average 8% return, you'll have about $447,000. That's a difference of over $320,000. That means saving alone can quietly make you poorer over time relative to inflation and opportunity cost. Investing solves that problem. Investing allows your money to grow beyond inflation, compound exponentially, and work without requiring your time. Wealthy people understand this fundamental principle. Their money works while they sleep, while they vacation, while they spend time with family. Step 3. Learn the power of compound interest. Compound interest is one of the most powerful forces in finance. Albert Einstein allegedly called it the eighth wonder of the world. It simply means earning returns on top of previous returns. Your gains generate more gains. Let's look at how this actually works with real numbers. If you invest $300 every month with an average 8% annual return, here's what happens in the early years. Year 1, you invest $3,600 and earn about $288. Year 2, you invest another $3,600, but now you're earning returns on $7,488 total, giving you $599. By year 5, you're earning over $1,500 per year without working for it. Your money is working for you. Now let's zoom out to the full picture. After 10 years, about $55,000. After 20 years, about $178,000. After 30 years, about $447,000. After 40 years, over $1,050,000. You invested $144,000 of your own money over those 40 years. The other $900,000 plus came from compound interest. The key factor here isn't huge amounts of money, it's time. Time allows compound interest to accelerate. This is why starting early is so incredibly powerful. Even small amounts invested young can outperform large amounts invested later. Step 4. Open a simple brokerage account. To start investing, you need a brokerage account. Think of it like a bank account specifically designed for investments. The good news is that today there are many beginner-friendly platforms that make this incredibly easy. You can literally open an account from your phone in about 10 minutes. When choosing a platform, I would focus on 3 critical things. First, low fees. Many modern platforms charge 0 commission on stock and ETF trades. Avoid high trading fees or account maintenance fees. Second, fractional shares. This allows you to invest in expensive stocks even with small amounts. You can buy $50 worth of a $500 stock. Third, automatic investing. The best platforms let you set up automatic monthly transfers and purchases. This is crucial because automation removes emotional decision-making. Popular beginner platforms include many well-known names. Do your research, read reviews, and choose one that fits your needs. The platform matters less than actually starting. Don't get paralyzed by trying to find the perfect option. Step 5. Start with index funds. If I started over today, I would avoid picking individual stocks at the beginning. Why? Because research shows that over 90% of professional stock pickers fail to beat the market over the long term. If professionals can't do it, why would beginners have better odds? Instead, I would invest in index funds. Index funds track entire markets. For example, the S&P 500 index represents the 500 largest companies in the United States. These are companies like Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, Visa, and hundreds of more. When you invest in an S&P 500 index fund, you automatically own tiny pieces of all 500 companies. That's instant diversification. Diversification dramatically reduces risk. Instead of betting your entire investment on whether one company succeeds or fails, you're investing in the overall economy. If one company goes bankrupt, it barely affects your portfolio. If the economy grows over time, you profit. This is exactly how Warren Buffett recommends most people invest. A simple beginner portfolio might look like this: 70% in a total U.S. stock market index fund for growth, 20% in an international stock index fund for global diversification, and 10% in a bond index fund for stability. This 3-fund portfolio is simple, effective, and covers almost the entire investable market. Step 6. Use dollar-cost averaging. One of the most powerful and beginner-friendly investing strategies is called dollar-cost averaging, or DCA. This simply means investing a fixed amount of money on a regular schedule. For example, invest $200 or $300 every month on the same day, regardless if the market is up, down, or sideways. Here's why this works so well. When markets drop and prices are low, your fixed $300 automatically buys more shares. When markets rise and prices are high, that same $300 buys fewer shares. Over time, this strategy smooths out market volatility. You end up buying at an average price without trying to time the market. You're not trying to predict bottoms or tops. You're just consistently investing. This consistency is what builds wealth. You won't panic when markets crash. You won't get greedy when markets boom. You just keep investing the same amount every month like clockwork. This consistency is what builds wealth. Step 8. Avoid beginner investing mistakes. Many beginners lose money not because investing doesn't work, but because they make emotional decisions driven by fear or greed. Here are the mistakes I would avoid completely. Mistake number 1. Trying to time the market. This is the belief that you can predict when stocks are cheap and when they're expensive, so you can buy low and sell high. The problem, even professional investors with teams of analysts and sophisticated algorithms can't consistently do this. Study after study shows that time in the market beats timing the market. Consistency beats prediction. Mistake number 2, following social media stock tips. When everyone on social media is talking about a stock, that's usually a sign you're late to the party. The smart money bought months or years earlier. You're often buying from people who are selling to you at the peak. Avoid the hype.
Stick to your index fund strategy. Mistake number 3, selling during market crashes. This is the biggest wealth destroyer. Markets will crash. It's not if, it's when. The S&P 500 has experienced dozens of crashes and corrections throughout history. Every single one was followed by recovery and new all-time highs. Investors who panic and sell lock in their losses. Investors who stay calm and keep investing during crashes buy shares at discount prices. Mistake number 4, checking your portfolio daily. The more frequently you check your investments, the more likely you are to make emotional decisions. Daily market movements are just noise. What matters is the long-term trend. I recommend checking your portfolio quarterly at most. Set up your automation and let it run. Step 8. Reinvest dividends automatically. Some investments pay dividends, which are regular cash
Payments companies distribute to shareholders. Instead of spending those payments, set them to reinvest automatically. Reinvested dividends buy more shares, which generate more dividends, which buy even more shares. This creates a powerful compounding loop that can dramatically accelerate your wealth over decades. Step 9. Increase investments over time. As your income grows, your investments should grow too. If you start investing $100 per month, that's fantastic. But when you get a raise, increase your investment amount. When you get a bonus, invest a portion. When you pay off debt, redirect those payments to investing. Small increases compound into massive differences over time. Here's an example. Investing a flat $200 per month for 30 years at 8% gives you about $297,000. But if you start at $200 and increase your investment by just 5% per year as your income grows, you end up with about $486,000. That's nearly $200,000 more just from gradually increasing your contributions. Step 10. Think long-term. The biggest secret to successful investing is patience. The market will rise, the market will fall. There will be scary headlines and moments of doubt, but over long periods measured in decades, the market has historically trended upward. Think in decades, not days. Wealth building is a marathon, not a sprint. Many people delay investing because they think they need large sums of money, but that's a myth. Even small investments grow into large sums over time. $50 per month, $100 per month, $200 per month. It doesn't matter where you start. What matters is that you start. The best time to start investing was 10 years ago. The second best time is today. If I had to start investing from scratch today, my strategy would be exactly what I've shared. Build a strong financial foundation. Understand why investing beats saving. Harness the power of compound interest. Choose low-cost index funds. Use dollar-cost averaging. Avoid emotional mistakes. Reinvest dividends. Increase contributions over time. And most importantly, stay patient and think long-term. Wealth isn't built overnight. It's built through small, smart decisions repeated consistently over years and decades. You don't need to be a genius. You don't need a finance degree. You just need to start, stay consistent, and let time do the heavy lifting. If you want to learn more about smart investing strategies, passive income systems, financial freedom planning, and long-term wealth building, subscribe to Smart Money and Investment Guide. Hit that notification bell so you don't miss our next video. Because in the next video, I'm going to show you the exact numbers, how investing just $300 per month with proper strategy can potentially grow to over $1 million over your investing lifetime. The math is simple but powerful. And remember, the best time to start investing was years ago. The second best time is today. Don't wait, don't delay. Start your investing journey this week. Your future self will thank you.